Welcome, everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. It is Tuesday. I am Barry Saywitz. We are back. We are talking real estate. We're going to do it again. I got a couple of things. It's a sunny and hopefully warm day here in Southern California, and we are post-election, so anyone who was a big Trump supporter or flies the red flag, congratulations to them, and those that were not on that side of the stick, there'll be some heavy drinking for the next couple of weeks. And there are still some races in the House that are undecided, and so we'll keep our fingers crossed for those candidates that are still out there and they're counting the ballots. In addition to that, I want to give a shout out to the UCLA Bruins, who are now on a 3-0 win streak, and we'll just take it week by week. That's all we can do, and keep hoping and praying. So with all of that said, let's shift gears. I want to talk some real estate. I want to welcome our guest, Sean Dudley, Senior Managing Director of NAI Capital Finance here in Orange County. Sean, welcome to the show.
Thank you for having me.
Yeah, so always good to see you. We go way back, and I'm glad to have you on. You've got a relatively new, recent role with NAI Capital in terms of commercial and multifamily financing and refinancing. But I want to start by taking a rewind. I want to go back to not the complete beginning, but to the beginning of your career. And I know you've held a bunch of different positions and you've done a lot of things in your time. How did you originally get into the banking and the finance side of things once upon a time? Was there a epiphany where you woke up and said, hey, I want to do this?
No, I think it was nepotism and mentorship, right, which is a lot of the way the world works. I always wanted to work with entrepreneurs, and I always wanted to be around real estate. And I saw banking as a natural foot in the door and a way to meet innovators and creators who had figured out how to amass wealth, how to be successful. And I wanted to know how to properly appraise the strength and weakness of a company or a real estate investment. And I wanted to lever that for my own use. And so that led me into banking through kind of various roles and opportunities in the market.
And so you've been doing this a long time, resident of Orange County, doing deals all over Southern California. And your role prior to where you are now with NAI was with First Republic Bank, which is unfortunately no more. But you were doing quite a lot of lending with First Republic on the multifamily side, on the commercial side, really all over when interest rates were at that all-time low and volume was very heavy. Mm-hmm. I guess compare that a little bit to where we sit today with higher rates, less volume, and what is the environment today in terms of what's going on, and how's it different than it was before?
Yeah, transaction volume has clearly slowed since that occurred, and I think that in terms of volume, we just see people being more selective about the investments they make, or it's more based on necessity versus wanting to just go out and make an acquisition just to do it. And that's a lot what we saw when interest rates were lower. It was easier just to go find an opportunity that made sense or an opportunity you could take a risk on because the downside was lower, right? And you had some years ahead of the actual loan maturity to try to make the deal work. So we're seeing folks now that are more well capitalized, I think, go out into the marketplace and make acquisitions. And we're seeing other people be a little bit shyer about refinancing, which is usually a big part of our business too, right? We have the acquisition side and we have maybe a 60-40 split of how that normally works. But yeah, today I think it's a grin and bear it and wait and see. And everyone has a tremendous amount of information on hand as well. So everyone's an expert about when rates are going to go up or when they're going to go down. And right now you have a scenario where folks are waiting for interest rates to go down.
Yeah, and if you go back, I don't want to live in the past, but I'd like to. But when interest rates were in the 3s and the 4s, and you had cap rates that were above interest rates, you could arbitrage the cap rate by borrowing at a number that was less than what the return would be, and so you could increase your return by doing that. In addition, if you added value to the property or the rents went up, you could then go back and refinance, and the interest rates were still low, and you could lock it in, pull money out, or whatever the case is, lock in longer, lower rates. And so for the people who did that for longer periods of time, smart move then, right? But the people that were doing shorter term loans that have loans that either are coming up immediately or in the next couple of years, I think that there's going to be a challenge there because they're going to go from these low rates to something that is significantly more. And if they weren't able to increase their rents, or if their operating costs have gone up just with inflation or cost of utilities and other things, you're getting pinched at both ends.
Right.
And so I'm curious as to what you think is going to happen moving forward. While no one's got a crystal ball, I think that there's events coming for people that still have these lower interest rates that are coming to the tail end of it. They're going to have to do something with it.
Yeah, that's right. I think that planning for an advance, you saw people go out and purchase properties in anticipation of having rents that maybe were never achievable, right? And they were being sold as if they were already stabilized at those rents. And so I think you have a lot of buyers that maybe aren't as well capitalized. They're going to have a decision to make. And that decision is all the things you just mentioned. It's going to be, what are interest rates? What are the other overall expenses? Does the NOI service what a lender wants to finance the transaction itself? And if it doesn't, they have to come in with cash to make that work, or they're going to have to perhaps sell the property. And that might be some of the opportunity that comes up in the coming months, coming years.
Yeah, and I think that'll be interesting because I'm waiting for that guy who's a little bit desperate. I'd like to talk to him. Maybe I'd like to buy his property, and I'm sure there's others out there who would like to do it. I think the dilemma, at least for the conversations that I've had, is that while people want to sell, they're still holding on to yesterday's dollar, and what they're selling is a property that they didn't really fix up because they didn't have the money to do it because the numbers started to get away from them, and they have yesterday's tax roll from a tax basis standpoint. They have yesterday's insurance. They have yesterday's pool guy that's still at a very low number, or landscaper. And then when you go to apply today's market rates to things, it whacks the cash flow even more and makes the deal just not a very attractive cash flow deal. And so you almost need to find a buyer who has delusions of grandeur of that everything's going to be great going forward, and I don't really care, and hey, Trump's president, and rates are going to go down, and everything's going to be good, and they'll seal off the border, and I can check all the boxes. And I'm not sure that happens. And while there are positive things that are going to come out of change in administration, I'm not sure that the light switch just gets switched in a day, and then that trickles down to the average real estate deal.
Yeah, I think what's coming up is interesting. Is within the next 3 years, you're going to have around $2 trillion in loan maturities. And in fact, in the United States, I think there's $4.5 trillion in total outstanding commercial real estate loans. You're pretty close to 50% of what's due. And I think that probably forces decisions. But more importantly, I think it probably forces the Fed's hand in a way to manipulate the interest rate environment, right? Albeit quantitative easing or something else. But you're starting to see them go after short-term interest rates when you saw them lower kind of that rate last week. But I think going forward, there's not really a choice, which is sort of a scary proposition. But the reality is that because of the monumental amount of maturities that you have coming, I do think that interest rates have to be at a certain place to service that debt. And sometimes things are that simple, right? And so we'll see what happens, in the coming years. But I do feel like it either stabilizes or you're going to be in a decreasing interest rate environment, which, most people would agree with.
But I don't think that the interest rate environment goes back to these 2s and 3s and low 4s.
Not without a catastrophic.
Right. I mean, it may not be high 6s and 7s, right? But if you're in that 5% range, that seems to be a reasonable middle ground where people can survive.
And the question is, does that 5% still service the debt that's outstanding? It does. And I think for a lot of properties, it does. And that seems like a pretty reasonable place to buy a property too, if you're a buyer, right? If you're thinking about historical averages and where things lie, like getting a deal in the 5% is actually a pretty good deal. But we do have, going back to the previous comments, when we have folks that just feel and look at things in the 3s and 4s, and that's why you still have sellers selling properties and staying on their perch at peak prices, and you have buyers who want discounts, right? They want to look at current environment and current economics, and they want some middle ground.
Yeah, and I think that a 5% interest rate in markets like Texas or Michigan or Tennessee, where you have cap rates in the 6s and the 7s and even sometimes in the 8s, that makes perfect sense because there's a logical dynamic in that if I could borrow at 5 and I can buy something at a 7% return and maybe I add some value and get it to 8 or 9, there's a return in there for me that makes sense. And that return would be better from a cash flow standpoint than playing the stock market or buying T-bills or something like that. But in California, really up and down, right? Whether it's Northern California, Southern California, Orange County, LA, it doesn't matter. You don't get that, right? Because nothing sells at a 5 cap necessarily, at least not recently and not currently, on current rents with current expenses. They'll sell it on a 5 cap after you do all the heavy lifting, if you're lucky, right, if all the cards line up. And so the idea of buying something here that throws off cash flow versus just something that maybe goes up in value down the road, that's the dynamic, right? It's really difficult to get into the multifamily market, and it's really difficult to eke out enough of a return to have it be like, hey, this is actually a good deal.
Yeah, it's a different proposition here in California, right? This is a maybe long-term appreciation play versus immediate cash flow need that you get in IRR or monthly IRR return that you get going out of state. And we've seen a lot of folks want to trade out of California for different reasons. Some of it's economic, some of it's political.
Government, right.
Yeah, of course, yeah. And some of it's just the controls that they don't have, I think, over tenants and they want. And then we've seen folks trade out of multifamily also to go out of state to get into different asset classes, triple net, or just something that's a little bit easier to manage.
Yeah, I agree. And so now in today's world of what you're doing with NAI Capital, you're seeing that, right? Because NAI has a brokerage division, they have a finance division, and then they're in multiple markets all over the place. And so I guess let's talk about what you're doing in today's world. First, let's talk about NAI as a company, right? Why them, and how is the platform working out for you in today's world?
I love it. I'm a culture guy, and that's coming out of First Republic, which was one of the best jobs you could probably have in banking in the United States, and rest in peace, all that kind of good stuff. But because of that, you just went out and looked for other entrepreneurial opportunities, right? And that's exactly what NAI Capital Finance is. And NAI Capital Finance is full-service debt and structured finance brokerage. It's led by Peter Steigleiter, who's a CEO, and Tom Preston, who's head of capital markets. It's affiliated with NAI Capital, which gives us some reach, I think, nationally and also into NAI Global. And it's an absolute value add from that perspective, and the access to data, analytics, access to real estate professionals that we have.
And deals, right? I mean,
deals, yeah, and certainly deals. And I think that was the advantage of, I think, coming over and having the opportunity to launch something that hadn't quite yet been started. But you got a good group at the end of the day, and that's what you're looking for from my perspective.
And you've got I don't want to put words around, but you've got a built-in network of brokers that are out there hustling, working on deals, trying to make things happen. And somebody's going to need financing at the end of the day, so why not bring it in-house? Marcus and Millichap has been doing it for years. CBRE's been doing it, and so this makes perfect sense. In addition to all your relationships that you built over the years, whether it's with First Republic or others, that you can then go back and shop around and try and get them the best deals.
Sure, yeah, it's not rocket science. It's really a service proposition, an enhancement of the services that they already provide, and I think that was probably the natural attraction for them to me and for me to them, right?
And so in today's world, you're going out, you're shopping for clients that are looking for financing to a variety of different lenders. Unlike we were at First Republic, I would come to you and then that was it. I didn't go shopping because I knew that was the best deal around, or I was comfortable with the terms, or all of the above. In today's world, people got to go shopping, right? Yep. And so your job is to really do that for them and try and get them the best, whether it's loan to value, whether it's rate, whether it's fees, whether it's a combination of all of those things.
Sure, yeah. And you're coming into a really interesting environment, I think, for everybody, where I think you'll start to see the commoditization of banking via technology, right? It's starting to be a lot easier to access rates, and people, sometimes you're talking to them, can actually identify the bank you're talking about by the rate or by the opportunity you're presenting them. But more than that, real estate is unique. Every property is unique in commercial real estate. And so it really does come down to who's underwriting, who's going to finish the work. And that's our real focus, is always on execution, especially when we're working internally with brokers at NAI on a purchase acquisition. You just can't afford to have it fall out or be sitting around with a contingency about to expire and not know what's going to happen. So the control, certainly the bird's eye view of who has the best actionable plan from a lending perspective, is there. And one of the things that we've seen is, obviously, you've seen banks do different things and be persuaded by different things that are happening with their balance sheet or something else. And what we've really seen is the rise of private lending sources and funds, right? And those are things that aren't as easily as accessible to a regular borrower that we know about and have spent a lot of time creating.
Yeah, and look, the term we use in our office is certainty of close, right?
Sure.
I want to make sure I get the deal done at the end of the day. The other issue is no one likes surprises, right? So when interest rates were bouncing all around, you'd have the lender coming back and retrading the deal or saying, hey, I can't do this anymore, or the rates changed, or hey, I'll do it, but I'm not going to give you as much money as I was going to give you before. And so that all affects then the buyer, who then goes back and tries to retrade with the seller. And now you've got this sort of spinning deal that's not on the trajectory to close.
Yeah, we saw the last, 60 days, certainly you had a total V, right, in the way that interest rates went and treasuries went, and you had a drop and then a significant upcharge. So you had millions of dollars of swings on some properties, and that's exactly what happened, but you can't control that. But what you can control is that they're not going to change their underwriting practices. Who's able to lock their rates, when they can lock their rates, and try to anticipate that moment and help a borrower and understand where they are, but at least explain it to them.
Yeah, and it would seem to me that's got to be one of the biggest challenges in the market where there's uncertainty, is trying to keep the borrower in check so he doesn't get squirrely with the seller as part of the deal. And then I guess the other thing is making sure that you have a clear understanding of some of these other moving pieces. So if the underwriter is going to use new insurance numbers and new operating expense numbers, that there's not a surprise coming back in the 11th hour.
100%.
Yeah, and so who are the buyers in today's market? Let's just look at, I guess we could look at all over, whether it's Southern California or not. It seems like it's probably like a theme, right? It seems to me, and we were talking about it earlier, who buys a multifamily property in today's world? Is a guy who's got a hard-on for a multifamily property and he just wants it because it's location, or it's near his house, or he just loves it, or it's a corner, or I've got money to spend and I've been trying to do it? Or is it the guy who actually is crunching the numbers going, this actually makes some pretty good sense?
It's hard on, right? That's the answer.
Yeah. Vote for the hard on. Right? That's what it is, folks. Yeah.
Now, I think it's well-capitalized buyers, whether that be institutional, high net worth individuals. In California, it's more about people that just want long-term appreciation and aren't as concerned about immediate cash flow. Outside of California, it's still people looking for deals, but we've seen some larger projects move based on other opportunities. We've seen people take a lot advantage of tax abatement and other strategies.
But also, you come into year end, which is where we are now, and then you, on both sides, I think, of the stick, right? If I'm a seller, I'm looking for a guy who's trying to make a deal by the end of the year. If I'm a buyer, I'm looking for a seller who's trying to get it off his plate by the end of the year. And that seems to be some motivator for both sides of the equation. But the trick is the sellers still seem to be, and I had meetings with several deals I was trying to work on, where the seller is stuck in yesterday's mode. And it's very hard to get them to recognize what they have or what the market is. And then the issue is you don't have 5 offers on a property, right? And so the property sits. And if it sits for more than a week, it almost looks like it's stale because stuff was selling in 2 or 3 days, and it's not supposed to anyway in a normal market.
And I think it's just strategic for those buyers that want to have properties in areas that they know and understand, right? Or it's a necessity of 1031 exchange, right?
Yeah.
Something like that.
Yeah, and look, I had a conversation with one seller, and I said, look, I probably know too much to buy your property. You need a dumb buyer. And they said, you're right. We're looking for that guy. Do you know him? And I said, that's not me, right? It's hard to do it, and then when it is, you want to make sure that you're going to get certainty at close, I think is really a big issue for people. And you don't have these sort of crazy terms going on now. I'm curious your thoughts, but for a long time when the rates were low, there were a lot of deals that were happening, I know for us, with no contingency, right? No financing contingency, no appraisal contingency. I was not concerned as a borrower that the property wasn't going to appraise, that it was going to come in short, or that the bank was going to retrade me. That didn't happen with low interest rates. As rates get higher, yes, it was retrading all the time. And then there's the question of it. And so now you have terms in transactions where the buyer says, hey, I want an appraisal contingency, or I want a financing contingency, and the seller's hanging out going, I don't know if this is going to go.
Yeah, you're supposed to have contingencies.
You're
right?
supposed to. Who made up that there's no contingencies? That seems like a crazy thing.
But we still see it. And that's sometimes the brokerage too. You see both sides, and they'll craft a deal, and they'll create too tight of a timeline, and then that timeline can't be met. That's when people start to stress out about it. But the reality is that in the current environment, banks are just going to get more conservative, right? If you have the scenario you're talking about, it means NOI isn't meeting what the purchase price is. And banks will generally lower loan to value so that the in-place debt service, or in-place NOI rather, meets their minimum debt service requirement. And I think it's just trying to be prepared for that. And what's interesting though is because you've seen values stabilize and maintain. And the
but are you seeing deals where the appraisal doesn't come in?
I haven't seen that, and it's always seems subjective in some ways, right? It's always going to.
The guy had the number because he knew, hey, this property is going to sell for X, and then okay, yeah, sure, X, good. I just got to justify it.
Yeah, but we're still seeing the transactions that want to go are going. We're seeing a lot of owner-user transactions as well, and that's the most competitive pricing that certainly banks are offering, and still on multifamily as well.
In terms of what your expectations are and what you guys talk about in-house in your shop, I mean, do you expect that with Trump in office, do you expect that with the Fed dropping the rate a couple of times, and perception is they're going to drop it a couple more, that will spur more activity going forward into the new year?
I think it should excite the market. I think what's interesting is when you have knowledge that interest rates are going to drop, sometimes that creates...
You wait. On one hand, you wait because you think it's going to get better.
Right.
And then if you're a seller, you hold on to your number thinking, oh, if the rates come down, the guy I'll get more money.
And that's maybe where you are now, though I will say anytime the Fed activates and does something like that, you do see activity, at least from a sales perspective.
Right, short-term blips.
But it's almost, maybe sellers get more excited and you do it that way. But I think long-term... It really goes back to the maturities we were talking about earlier. I think that's gonna be what drives the market. Obviously, Trump's a real estate guy, and I think he'll be active out there and trying to help the market move. But I really just feel like everyone's hands are tied, and they're gonna have to manipulate. They're gonna have to manipulate rates and treasuries, for that matter. And I don't know what that means. I don't know if we have the same demand we've had previously from international folks buying our treasuries, but I still think that people will gravitate towards that. And I think the next 3 years is going to be driven by loan maturities, and that's going to be what creates a market for sales.
Yeah, and I think a lot of the borrowers and the average person, when you have coffee talk or dinner talk, gets focused on the rate, right? And rate is not a single rate for a single deal that applies to everything. There are multiple different kinds of rates that apply, and a home loan rate is different than a commercial rate, different than a multifamily rate. What are you seeing from the lender side of things in terms of their desire and want to lend? Period. My perception is they have money, they want to lend. They're just trying to figure out who's out there and who can I give it to.
It's really specific asset classes that you've seen. I guess if we just look at banks, what they're more focused on. I think the falling knife we haven't seen yet and are maybe avoiding the conversation or thought about is what happens to office market and how does that impact balance sheets. You've seen a lot of kicking the can down the road. There wasn't a ton of activity last year on the refinance or purchase side. We've seen that pick up a little bit more and rates get a little bit more aggressive. But again, it's on the assets they want. So, owner-occupied commercial real estate deal on the conventional side or SBA side, you're still seeing rates actually in the 5s, depending on if it's top credit quality. We're still seeing multifamily deals in the low 6s currently, but that can change based on deal type and lender. I just think the overall appetite, though, we'll see where it goes. And I hate to say that being in the position I am. It's just every bank has a different appetite and a different underwriting criteria and certainly a different geography that they're looking at. So our focus is always trying to find those lenders who are active in the moment, and you pivot out of that and find another one if that changes.
And his history has shown us that there's always a new guy on the block that's willing to go a little bit more aggressive. That's how First Republic got in the mode and then kept going with it, versus some of the bigger guys, a la a Wells Fargo or a Chase or a B of A, that are so big that they don't need to go outside the box. It's just not a necessity. And they're willing to lend, and their rates may be good, but the underwriting is very difficult.
Yeah, it's just how well capitalized a bank is, and you're certainly going to get lenders that are going to pick up and carry the rock and run with it when they can. And someone wants to own the space, right? There's banks that want to own the multifamily space, which is smart. And I do think in present environment, if a bank's financing a deal, and especially in California, because of the amount of equity you put in there, the loss potential is actually fairly low in a higher interest rate environment. I do think you'll start to see some more aggressive action here at the beginning of the year. It's just been too stagnant. But I think they're all, again, waiting to see what's going to happen with their portfolios, and they want to trade. And the other thing that we haven't seen yet is, regardless of what the Fed does, deposit rates are expensive, right? The banks are paying a lot for deposits, and if they're going to go out and do loans, there has to be some give to make their cost of funds make sense. So there's always generally a little bit of a lag. And I think the interest rates that you're seeing right now, some of this was anticipated what the Fed would do on the short-term basis, and that's why you're seeing the rates you are. But maybe there's a little bit more give, or maybe this is the give, right?
And do people get, from your perspective, caught up on, the Fed drops the rates, therefore everything else should be cheaper? Because I think that's also a common misconception, which is, the Fed drops the rate, therefore my home refinance should be at 4%. And then the answer is, no, that's not how it works. Right?
It seems to be a little bit more relevant actually on home finance, but yeah.
It is, but it's still not a direct correlation. And I had a conversation early this morning with somebody who said, look, don't focus on what the Fed is doing, focus on the treasuries, because that is more of the standard bearer of where long-term interest rates are.
Yeah, I think what the short-term impact of the Fed is really just what banks borrow from each other. And they've borrowed for 15 years at near zero, and then they had a program in place where they could borrow again, and they were using that kind of to do their loans. And then they're all just really spending the time the last couple years of trying to recapitalize and get their deposits up. But yeah, it does not have a direct correlation generally, at least right away, I think, on what you in financing rates. Really, treasuries are a better indicator of what the rate environment's going to be.
And what about the concept of the deposit relationship from banks? I know with First Republic that was a big motivator, because it wasn't the philosophy wasn't, I don't want to just make you a loan, I want to be your business partner and I want you to bank with us, which makes perfect sense. And you have many other banks that have taken that philosophy. And then some of the larger banks don't really care because they already have all the deposits and they're heavy on it. Is that a factor in the day-to-day of making a deal today when you're going out to find a loan for somebody?
Yeah, and that was probably, and not to say that banks didn't always care about relationships, because I think they did, but I think if you're looking at what the impact of First Republic not being there any longer is, one, maybe rates are less competitive on multifamily and some of the other ones, but as the other banks watched and learned from that, I think you've definitely seen it be more relevant. But it's also a requirement. It's just, again, capitalization. They have a certain requirement that they have to have. They have a certain amount of capital to deploy. And because the environment is tighter, it allows them the ability to make that a requirement. I think that's what I think about too. If I'm pairing with a borrower, is what's their capacity to continue to do loans? Will that lender that you introduce them with, is that someone that they can bang with and continue to do deals over a long period of time? And that's probably the relationship component versus just everything being transactional. And we'll see how that goes. But I think that's what you're seeing with a lot of the regional banks. It's just a necessity for them. They have to have some form of deposits to continue to lend, and it's a give and take.
And that was my next question, is so for the buyer out there who's just trying to buy one property, because I'm just trying to get in the market, or that's my one thing, and I'm not the guy who has a bunch of different loans that are coming due, or I'm going to buy a whole bunch more, I've got a bigger story to tell. How difficult is it for that borrower to get money and to get a loan in today's environment?
We're seeing there's always a way to get someone a loan, but how to get the best loan is going to be driven by probably their relationship component. I would say there's still financing available for nearly every type of deal, even value add, right, where it's not debt service. It just depends how you go about it. First time buyer now, I just think it's a harder market for them to enter, and they have to have a different expectation of what that is. And so we're seeing a lot of folks, it's more secondary now, people trading and going into that.
Right.
First time buyers it's just not as many right now. But yeah, those folks, they're still financing for it. Maybe they're more likely to park money somewhere to get a deal, actually.
Yeah, but I think it's still a challenge overall, for sure.
100%.
And then what about from a lender's perspective in terms of looking at the borrower's credit versus the deal that stands alone? Guarantee, no guarantee. Do I just look at the cash flow of the property? Am I really looking at who the borrower is at the end of the day? It's obviously on a case-by-case basis, but I'm curious your thoughts in terms of just a trend of where it is today versus where it might have been previously.
It's property first, but certainly you can command a guarantee as a bank, and I think they absolutely look at secondary source of repayment, and that's, again, mechanism of where things have gone. If you you financed a deal 3 years ago and you bought it, it's a much different deal today, right? And what's your capacity to deal with an issue? And so I do think they absolutely look at the guarantor.
And what about location? So obviously people love the coast because there's only so much of it, and the numbers are higher. And so from a banking perspective, I'd like to make a bigger loan if I can. At the same time, the numbers are thin or non-existent, right? And so it's a catch-22. I've got a better location and a better property and maybe more security because of that, but I really don't have any cash flow. Versus if I go inland or I go to parts of Los Angeles that might be more bread and butter, I've got other challenges, but maybe have a little better cash flow.
Yeah, I think cash flow is what drives deals, right? I think what banks are looking at with respect to that is whether, what are the in-place occupancy, what does the labor force look like, what's the ability to keep having tenant demand, where a coastal property, the benefit is, yes, it's worth more, but actually the NOI is lower, so the loan amount is lower, making a lower loan to value, right? So it's a little bit safer investment because people have to put in
more
additional
money.
Cash.
And so what does that look like? It used to be that you could go up to 75 or even 80% loan to value. with some of these loans. And then for a while, that was just out the window, and you were looking at probably 50% on its best day. Has it stabilized now where there is a little higher loan to value depending upon that cash flow, or not so much?
No, I think the rates haven't really driven to that. They're a little bit better than they were, but where we are currently in the V again.
Yeah, it just doesn't pencil.
Just doesn't pencil. Yeah, I think you're in the 60s there. The agency debt has really driven the way. It's just been much more competitive than other loans, and that's just a different appetite for staying in a deal longer and staying in a loan longer and being comfortable with what the loan is presently versus refinancing it down the road because of the prepayment penalty and the expense of actually taking it on. So for larger deals, we saw everyone really pivot just into agency. And some CMBS had a moment for a brief while where that really came back hard, even for multifamily, where you wouldn't normally see that for years. Yeah.
But the advice in today's world is if you're a buyer and you're looking for financing on whether it's multifamily or commercial property, you've got to get somebody, no different than getting a good lawyer or a good accountant. You've got to get a mortgage brokerage company or broker or someone to assist you in going out, shopping the deal, getting the best deal that's out there for you.
Yeah, I think it's very hard to navigate. And I'm not saying that because I'm in the industry. It's just even when I was in banking, a lot of my best relationships were with brokerage because they had a pulse on who the borrower was, who we were, what our fit was, whether they're going to have an appetite. And I think it's very hard to navigate in current environment with it changing all the time. Yeah. And because of our transaction volume, because of how long we've been doing this, we see those lenders that come in and out of market. We see the ones that want the business. And that's what you're trying to do is marry two parties that are going to be happy together and that's going to be successful. You don't want a loan to go bad. You want everyone to know who's going to be in there because it's a long-term relationship. And that's even a first-time buyer can be someone that ends up with 10 properties down the line. And to your point, it's maybe as important as having an attorney or anybody else in your team, or a CPA, just from an advisement standpoint. And sometimes even a lot of folks send over deals and say, does it cash flow? And how's the lender going to look? And that goes into whether or not they want to purchase the property.
And as a seller, I would say the same thing, which is I would go out and I would come to you and say, what do you think it's worth based on the cash flow and based on what a buyer can get a loan for? There's not that many people out there that just write a check and pay cash. And so if I'm going to get a loan, that's going to back into my price at the end of the day.
That's the number one way a broker started using us, I think, at NAI Capital Finance, which is what's the market look like? And we usually do a pretty in-depth analysis and come back to them with that information so that they know when they have a prospective buyer if they know what they're doing, right?
All right, so we've covered a lot of ground.
Sure.
I'm going to try and put you on the spot, but I mean, going forward, 2025, more transaction volume or less than 2024?
I think it'll be more. I think the rate environment should get better. It should compress cap rates. It should create some activity. And again, I think the thing you're really keeping an eye on as a buyer or a seller or someone who wants to refinance is just loan maturities, right? And that the rates are going to improve and hopefully the economy. But I do think that we should see some improvement. I think it's going to be a little bit later into the year. I don't think it's instantaneous in January.
And so if people want to get more information about you or about NAI Capital Finance, where do they go? What's the website?
NAIcapitalfinance.com, all spelled out.
Got it. I'm not going to spell it for you.
Thank you.
Seems to be, you can figure it out. Look it up if you can't figure it out. But as always, pleasure chatting with you and getting your insights on the market and picking your brain. And we'll look forward to trying to do some more stuff in the new year to come. And so I appreciate you coming on the show and sharing your thoughts with us.
Thank you for having me.
Yeah, so much continued success to you, your family, your company. For those folks out there, we will be back here next week talking more real estate. There'll be new and exciting things. I guarantee it. And if not, we'll make something up. So for everybody here, I want to thank the whole team at OC Talk Radio, Paul, Sophia, all the folks behind the scenes. I'm Barry Saywitz. We'll see you back here next week on Let's Talk Real Estate.
There you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.